I'll give you a quick introductions to Dr. Brian Healy and Dr. Nick Firoozye. Nick got his PhD, his maths PhD from the Courant Institute, NYU, and basically taught for a number of universities in the US following that, including NYU and the University of Illinois. He then spent a couple of decades, over 20 years, I hope he doesn't mind me saying that, working in the finance industry in both buy-side and sell-side firms. He's an honorary professor in computer science at the University College London. And he actually began teaching algorithmic trading strategies in 2015. Nick, correct me if I'm wrong, but I think it's 2015. And since then, he's adapted the content of that program to create a master's course, which has run for the last 4 years or so. Really successful, very popular, over 500 students. And he's also co-authored a book, which is well worth a read. It's entitled Managing Uncertainty, Mitigating Risk. It's very topical. It's all about the role of uncertainty in finance in light of the many recent financial crises. And his co-conspirator, Dr. Brian Healy, is also a mathematician. He also has over 20 years experience in the financial markets, working as a quant, working as a trader, a researcher, a strategist. He runs a very successful consultancy business as well, which specializes in building models using the latest mathematical, statistical, and machine learning techniques. He has particular expertise in quantitative strategies, options, and other derivatives and predictive modeling. And he's a professor of machine learning and data analytics at UCL. He's a lecturer in finance at UCD, and he's a researcher and lecturer in mathematical and computational finance at Stanford University. Like Nick, he is also an author of many peer-reviewed papers in mathematical finance, and he's a frequent speaker at conferences and seminars. They are both, as you're about to find out, if you haven't already found out before this presentation during their discussion, they complement each other extremely well. They're both deeply knowledgeable about everything to do with algo trading, the applications of algo trading. It's basically their passion. And I'm sure that'll come out in this presentation, which I hope you find interesting, enjoyable, and in particular, really useful. It's just an information gathering exercise for everyone here. And if you've got any questions in the coming days and weeks, then feel free to get in touch with me. I'm basically responsible for everything that is not to do with the content of the program. But whether your questions are to do with content or not, come through to me anyway. I'll put my contact details in the chat box, and feel free to give me a call or to send me an email at any time. And in the meantime, I'll pass you over to Nick and Brian.
Okay. Well, thanks very much, Jeff, and thank you for the introduction. And I guess we can just start right in. And Brian and I have not coordinated, so we're probably going to interrupt each other all evening long. Basically, this is welcome to the introduction to algorithmic trading, a practitioner's guide. Just can tell you this is the second cohort we've had of the algorithmic trading certificate. We're quite excited about it. It's a slight change of format from the previous time. We're going to be doing it over the course of 12 weeks. And we wanted to give you a good introduction tonight, just to explain what it is we plan on covering. So, and as an outline of the next hour, an intro, who, what, and why, what the syllabus is, some of the prerequisites, and how we will assess you, and then wrapping it up. In terms of the introduction, so algorithmic trading is a broad term for trading which relies on mathematical models and algorithms. sometimes called quant trading, sometimes called algorithmic trading. It's sometimes called systematic trading. We try to be all encompassing in this and try to make sure we're grounded in the theoretical side of things. I see I have a chat here. There's a but here. Let me go to the next slide. I'll answer it in just a second. As markets have become more automated and increasingly large volume of trades are executed using algorithms. So basically like e-trading, high frequency trading. It's a whole segment of the market, and one that people are very active in. In fact, I'm currently doing some research in that area with one of my PhD students. Many exchanges are now dominated by high frequency market makers with increased volume and speed leading to higher returns. Algorithms can be used for all aspects of the business, from high frequency to low frequency, in trade decisions, portfolio allocations, and in placing orders. Actually, Brian, maybe I'll let you take it up from here.
Sure. So right from their genesis, some funds were quite algorithmic from the start. You know, funds like Renaissance, etc., that you may have heard of, D. Shaw, etc. Right from their, you know, their DNA is in very quantitative algorithmic trading. Other funds have either become more algorithmic in their approach as time has gone on, or they have launched sort of separate structures, funds within themselves, which are algorithmic. So a lot of funds now are 50% algorithmic, systematic, 50% maybe discretionary. So there are lots of instances of that in the bigger funds where there's a mixture of the two. And as the previous point just alluded to, so it can be used for either the signals, the alpha, the trade decisions, or it can be used for just placing the orders, or both. Next point, Nick.
Yep.
And some shops, albeit still not that many, to be honest, but some shops automate absolutely everything from, you know, from start to finish, from even the research in a sense is automated. The looking for signals, the implementation, the execution, everything from A to Z, or Z as Nick would call it, is completely automated.
Actually, of course, there's some only automate parts, which,
Yeah.
you know, for instance, automated execution is not necessarily possible in every asset, but sometimes it's, you know, it's considered algorithmic because all the decisions are made prior to the actual execution.
Right. I mean, just to give you kind of a very common example, a lot of even like completely discretionary funds may execute using their prime broker, using like a VWAP algorithm or something like that. This is perfectly normal. And we'll see that in the course. And, you know, so some people would say, well, you know, that's kind of algorithmic, right? Their execution is algorithmic. And in a sense, it is, even though it's somebody else's algorithm they're using, you know, the execution, yes, it is algorithmic. So in order to get best execution, or to improve their execution, or to get a better average price, et cetera, there are lots of different reasons. Firms often essentially, you know, outsource their kind of order routing to third parties.
So who is this course for? Well, it's for discretionary traders and risk managers. People want to understand the mechanics of the market and develop the tools to devise and manage new and improved algorithmic strategies. They learn about the pros and cons. There are a lot of discretionary traders who want to understand algorithmic trading, some who want to move in that direction, or some who want to potentially manage desks that have not just discretionary but algorithmic slots in them. And so there's a lot here to sort of take on, as well as risk managers, who some of which are moving increasingly into risk managing you know, systematic trade flows. Of course, algorithmic traders themselves. And this course is meant to guide. You know, there are many people who do algorithmic trading who've sort of come across it, who aren't necessarily grounded in the theory behind it. We want to understand both the theory and the practical applications. In our course, we plan to cover both. So algorithmic traders can gain from this because they can appreciate when commonly used strategies work and when they don't, and understand the statistical properties of strategies, basically expanding the toolkit to incorporate the latest techniques. Because in this, we'll touch on not just the areas which the sort of the historic areas, but also areas that are currently under development, because there are many innovations ongoing in every area that we will touch on.
Yeah, and I'd say there as well that on that point that there is a lot of people in the algorithmic trading space in its broadest sense who have come from almost a computer science type background, who don't come from a statistics or a finance background, which is obviously fine. However, I think in order to really appreciate and develop good algorithmic strategies, I think the statistics is absolutely critical. I think you really can't do this very well or manage the risk either until you really understand the stats. Now, probably Nick and I are slightly biased in that regard, but I think that is the case.
Yeah. No, I fully agree, and I think it's sort of the statistics is necessary for effectively when we're making decisions, or you could say it's statistical decision theory, but it's basically it is effectively finance, and you could ground it in machine learning, you should ground it in econometrics, but it one way or another is all the same effective set of tools for guiding us in how we make our systematic decisions. And of course, it's appropriate also for graduate students and data scientists who can gain familiarity with algorithmic trading strategies and master the underlying theory and mechanics behind the most common strategies. As Jeff mentioned, both Brian and I are used to teaching master students at UCL, and I currently have a class of about 120 master students, many of which have been taking areas of quantitative finance or data science and finance. There are a number of different master student programs that converge, but this gives them, our course is meant to give a grounding in the entire industry and as well as the strategies that are commonly in use. Okay, as this is something that Jeff's already covered. As he said, I've been around for 20 years at least. Been in a number of firms. I'd say since the past 10 plus years, I've been working in purely systematic trading. So whether it's in a QIS desk, a QIS is an area, a part of a structuring team in a sell side firm, devising relatively pure and simple strategies to sell to clients typically via total return swaps. Or through structured notes. But so I was initially doing that and then working on other sort of purely quantitative trading methods in various different hedge funds and securities trading houses since then. I've been teaching this course since, as Jeff said, 2015. So had a good deal of background in what the appropriate material is to cover in this course. And Brian and I have sort of refined that in more detail because there's a lot of material to cover. But I think that we've sort of gathered what we think is the truly appropriate for this specific course.
So again, Jeff has covered most of this already, but like Nick, I have over 20 years experience in the industry. I guess like Nick, I'm a mathematician by background, and also I started off really on the sell side largely, and worked at a number of different banks. Slightly different to Nick, I was more on the sort of trading kind of quant side, specifically in options, multiple asset classes. And then since then, I've been part-time academic and part-time consultant, where I've worked with everything from private equity companies to gambling companies, anything to do with pricing, risk, predictive modelings. I've been fortunate to do things that I find interesting, to be honest, and worked with some very smart people in a number of different domains. And in terms of specifically algorithmic trading, I've always had a kind of a passion for the trading business, and so that's where I started working. And I've worked with a number of hedge funds and similar firms on the trading side, and I'm currently actually at a hedge fund as one of my clients. And I teach at UCL also, but I teach kind of machine learning and data analytics class to about 50 students, again at all of master's level. But I do, I'm teaching a stat arb class in Stanford in a couple of months online. So I dabble in anything to do quant finance, particularly if it involves options or derivatives. I'm generally not far away. So I think that probably is a...
Yeah. So one way or another, Brian and I have had quite a number of successful students. Many have gone on to careers. Some have actually even came from careers in quantitative trading, done studies with us, and then gone on to continue their careers. So what are the goals of this course? Maybe Brian, you can continue with this.
Yeah, sure. So first and foremost, we want to, and we will provide students with a strong foundation in the important building blocks that go together to make a algorithmic trading mindset, business, etc. So what tools, techniques are used in the industry, kind of what are best practices, what does an algorithmic trading business look like? What do they do? What do they trade? How did they do it? So for those, particularly for those who perhaps haven't come directly from a trading background of any sort, I think this is a really important bit to get right, to sort of get even just the jargon and the terminology and all that, to get that down first. Then, in order to build any strategy, algorithmic or otherwise, really, you need to have some data sources. And the number of data sources is proliferating all the time. So originally, even 20 years ago, we started off with just sort of price data. Then price data became more granular, intraday, down to microseconds, nanoseconds, and all the different markets, everything from futures, individual stocks, currencies, all the other asset classes.
Right. I would say some data sources and some alphas are just almost just a challenge to find based on the size of the data.
Right. And, some of you will have heard, if you've read things like Flash Boys by Michael Lewis or other sources, you'll be aware that there are lots of other data sources that people use now, everything from satellite data to, data on weather data, et cetera, et cetera. So there's all, people are mining millions of data sets all the time, some of which are daily data, weekly, monthly, some of which go down to much higher frequencies. So just, first of all, we just need to have an overview really of kind of the types of data that people use, roughly what do they use them for. We obviously can't go into every single example because we'd be here forever, but it will give you sort of a flavor of, again, what people actually are doing in the industry. And because Nick and I work in the industry, we know that, in real time, what is actually being used right now by real researchers, portfolio managers, chief investment officers out there. And then, none of this really kind of sinks in. Nick and I have been teaching for too long, and sometimes I think, but in order to get stuff to really sink in and to make stuff make sense fully, it's important to work with practical examples. So right all throughout the course, we will give exercises, examples, stuff for you to work with, assessments, etc. So it will all be very much practically focused. It won't just be us going through a load of slides with some nice theory and then you're on your own. The emphasis is absolutely on practical implementation of everything. And by the end, then, the final project, as it were, or assessment, is to build an efficient, scalable model in particular for the course, but in general, you will be in a position that you can go find some data, analyze it, build a strategy, look at the risk, back test, etc., in sample out, all of these terms that you'll become familiar with if you're not already. And you will be able to come up with a strategy which you can present in a, in a nice, consistent manner that might get you an investor, for instance, or might get you a job or whatever it might be. But there is kind of a, state the obvious, there's a right way and a wrong way of doing it, right? And people kind of expect to see things in a certain way. Things have to be done in a certain way, and we will demonstrate all that. Do you want to go with that, Nick?
Yep. So this is a fully revised version of the course, Algorithmic Trading Strategies, that I've taught at UCL. But one of the emphases here, unlike the UCL course, which is of an academic nature, this is meant to be, much more practical in terms of it, in terms of our approach, because we want to give you much more hands-on experience and with a sense that what you would be expected to do in the course of a career in algorithmic trading. And I should say this, I should correct this, is from 2016 to 2024 because it's ongoing right now. They say over 500 students have completed it and found the material very useful in their subsequent work in industry. I've had students come up to me and say they discussed momentum in an interview the week after we covered it in class. So there's quite a number of and knowing it's not just trend following. Maybe you all have done some trend following yourself, but what the specific properties of it are, and why it's so popular in the industry. Those sorts of things. Those are very important matters because it sort of keeps everyone a bit more on the same page.
Nick, there's a question here from Sunil we'll just deal with in real time. Do you think high performance and backtesting of a strategy is sufficient reason for us to deploy funds in that? This is a very interesting area. So a lot of what we discuss in the course is around the idea of backtesting and demonstrating that a strategy does actually work. The critical point is, how was it backtested? If it was backtested what they call in sample. So if it was tested on data that it had already seen in building and training the strategy, then the answer is a definitive no. If it was trained or tested properly, which is out of sample, and there are other things that need to be considered too, then maybe I would say is the answer. So I can definitely say no if it was an in sample. A lot of stuff you see out there are in sample tests, and you should never take that seriously.
Yeah, it's one of the things about even when we do even when people present paper trading, it's a bit different when it's as Brian says, it's fit prior to that and everything is frozen and then run forward. And still then it's not quite the same as trading it live because you don't know how you'll execute. You don't know what the slippage actually is, despite your best efforts for trying to model it. And there's good efforts and there are much better efforts for modeling slippage. But yeah, all these things have to be taken into account. In terms of raising funds for an investment, of course, there's also there's not just the work you put in it and the back test, but there's also the how you present it. There's the theory behind it. There's quite a lot that can go into that, and we'll try to cover that in some detail. So yeah, this course takes a hand-on approach to building the strategies through the entire pipeline, from the data all the way to the features, to the modeling, to allocations, to execution, and then subsequent to execution, there's performance and risk measurement. So you're supposed to guide you through the common practices as well as the areas that are sort of where there's ongoing discussion, debate, innovation, some of which is academic, some of which is in the industry. There's a lot. It's a very rich and growing area. And as we said, this is the second cohort for the ATC. It's now expanded to 12 weeks. We found that the material is probably easier to cover in the course of 12 weeks because there's a fair amount to cover, and we think this gives a bit better spacing. Okay. So we'll cover the syllabus very quickly because this is online, but essentially we'll be covering things like the industry overview, what the different houses where one employs algorithmic trading, whether it's systematic prop trading, purely systematic hedge funds, high frequency trading shops, the CTAs or trend followers, algo trading teams and multi-strats, which are also quite a growing area. QIS teams, I mentioned the quant investment strategy teams in investment banks. They typically are launching indices for index swaps, and they're actually a growing and competing area against some of these others. And then meanwhile, the investment bank e-trading teams or the market making teams, they're either doing automated execution or automated market making. The execution doing it on behalf of their clients, the market making, of course, on behalf of themselves. And we'll look at the capital markets penetration by sector, because there's each of these areas is large and growing, and we think an increasingly important area of finance. Then we'll be covering data sources of the many different types of data sources, both market data and alternative data sources. Alternative data, of course, growing, and some of this is where people get their edge, where they get their significant alpha, is where they can find data and extract the value before others have gotten to it. And then we move on to feature creation, feature storage. There's a lot of the practices here are best practices kept from that are from the machine learning, the ML ops area, because large machine learning models need quite a lot of DevOps for them, and so the ideas of feature stores, that's an area that's used a lot in deep neural nets. It's also something that's used in algorithmic trading. So then feature selection, feature relevance, but as well how features are used differently by different sectors in the market. So like some shops using features as features in a model, some of them launching what are called factor-based strategies, which are effectively very simple feature, using a very simple feature to define a specific strategy, and then balancing the strategies in portfolio. And then, so again, factor investing, this is, we cover CAPM and APT, arbitrage pricing theory. Fama French factors is something that equity guys are really, everyone's schooled up on. We look at equity risk, quant risk factors or styles. We look at other types of styles, which are risk parity or low vol or low beta. We look at other factors and the entire factor zoo, or the factor proliferation, as well as risk premium strategies. And I can't remember how many more pages of this we have, Brian, but there's
I can do risk premium strategies.
Sure.
We look at the main, we divide up the emphasis as far as possible into what's kind of most important, most prevalent, most interesting, most common. So things like trend following, momentum are huge. Carry strategies are very important, as a mean aversion. And you'll have heard of relative value, statistical arbitrage, etc. And then some sort of, as we go down here, there's some slightly less common strategy, but that are also very important, and are kind of important to understand for your general understanding of how the market works, because they have an impact on the market. And things like cross-sectional is obviously very important with equities, because there tends to be a lot of them. And people look at these equity factors, equity styles, and rank things according to them and trade portfolios. So there's lots of different ways of trying to extract risk premia from the market. And in all of this, in a sense, what are we doing here? It's always an element of forecasting. So we're always really, one way or another, trying to forecast the value of things in the future. And so we can sort of take that, strip it back to, to the fundamentals of time series, forecasting, moving average, autoregressive processes, et cetera, and the filters, just Kalman filter, again, all of which are super useful when you're engineering your features, I think as well, it's really important to know all this stuff, to have a rigorous understanding of these stats. What does stationarity mean versus non-stationarity? Things like co-integration are very important for, particularly for like the stat arb and mean reversion strategies. And vector autoregression, this is vector autoregression rather than value at risk. And how to model seasonality, particularly important in some of the commodity futures, and so on. So again, there's some of these are kind of more common, more used than others, but they're all important in their own way. And then we've mentioned feature selection already, but regularization is a big issue with modeling, where in order to really improve the performance of the model, you can kind of apply these regularization techniques, which can be quite mathematical, but some of them are relatively easy to understand, and we'll go through them. Training versus testing, I've mentioned in and out of sample already. There's a question about cross-validation I see on the chat, which we'll come to in 1 second. And ensemble methods, which are really ways of combining different approaches to kind of end up with a better approach, to put it loosely. So once we've studied some of the ways of building models from features, then we can see ways of actually improving those models in, either reducing the variance, reducing the bias. There's certain things that we can do to make it better in some sense of better. And that change points and regime switching is really important in finance, because one very annoying feature of finance is that things don't stay the same. We're always dealing with time series. So we have periods of, we'll say, high volatility, and then we have periods of, say, low volatility. And being able to detect when you're moving from one regime to another is critically important. I'm sorry, Nick, you were about to say something.
No, I was going to say we each have our own favorites. So and some of the challenges, of course, we can't cover absolutely everything in immense detail. But what we do is we give resources, because we've got lots of other reading materials for those of you who want to dig deeper into each of these areas. There's a lot that can be said about, like say, for instance, change point detections versus regime switching. That's an area of ongoing work. Ensemble methods, of course, it's something that's very prevalent in machine learning, but also very important. And it's also a good way of making for better efficiency, especially if you're doing something like bagging. You can use a cluster of machines to do your bagged forecasts. But anyway, we'll go into some detail about each of these. Now let's see if I can flip the page. There we go. We'll also be looking at model updating, so adaptive methods. That's again one of my favorite areas is sort of online adaptive filters, which are very common in signal processing. So RLS, EWRLS, or common filters, and then look at the difference between, to some extent, between batch models or online learning, because for things like mid-frequency forecasting, there's some benefit to being able to update on the fly. Then actually, Brian, you're going to cover ML models in some detail.
Yes, when I'm off mute. So again, I don't want to go into too much detail now, but a dirty little secret really in finance is that a lot of ML models don't work very well. However, we will reveal, as it were, which ones do actually add a lot of value. And we'll even sort of look a little bit at some of those that don't, but that are kind of used a little bit. But things like reinforcement learning, long short-term memory, there are things that work quite well because the nature of finance with it's a time series, and the signal to noise ratio is quite low, which is why it's quite difficult to make money. But there are lots of methods that do work quite well. Some really important general methods like kernel methods and non-parametric stats. And then I mentioned there random forest as well. But yeah, there's lots to look at in machine learning, but what we really focus on is on what works, right? A, because we don't have time to do everything, but B, because there's not much time in spending your valuable time on stuff that doesn't really add value.
Actually, I have I quote from it before, but there's a paper by a sociologist who studied the sociology of quants on the street. It was commissioned by the EU. It was back in I think 2018, and focusing on machine learning and the sort of the penetration of machine learning methods. And although he found that there was a tremendous enthusiasm for machine learning methods in finance. Typically, they were not there was not particularly deep penetration, and there was actually a fair amount of it was like sort of machine learning it was with significant constraints as a way of preventing it from because with machine learning there's a lot of flexibility, and with algorithm trading there's potentially a lot of danger. So there were a lot of constraints, not very deep neural nets, as we've seen in the papers, for instance, of Brian Kelly, that a lot of times more shallow neural nets are more robust. But there's, as I say, a lot of enthusiasm. So this is an area of significant ongoing research. And I just should mention, I know there are a lot of there are some interesting questions here, and we should get to those as well. And I know that some are actually related to this.
Yeah.
But yeah, so Sunil asked about k-fold cross-validation versus fixed train and test. Okay, so I mean, typically, I mean, I'm gonna say it's reasonably common to do k-fold. It's a little bit challenging for time series specifically. You know, a lot of these methods are meant for I'd say less for contiguous data or for things that preserve sort of an autocorrelation. So it's much more common to do sort of just a run forward analysis. You fit from, you know, you fit over one period and you test one day ahead, and then you do again. You don't test one day ahead. That's actually very, very common in finance. And there's something to be said for that as well, as long as the hyperparameters are fixed well in advance, because that is effectively trading as you would go forward. So yeah, we can talk about k-fold cross-validation versus fixed train and test. I'd say k-fold is probably more of the standard in machine learning. Fixed train and test may actually be more common in finance. I guess Nancy asks about basis trades in U.S. Treasury markets. I'm going to say that that's something that is I'm going to suggest that is not as commonly done in purely algorithmically, just because it's such a big trade. You know, there are a lot of funds that's the trade they do. If you look at some of them, like, you know, there's Capula, let's see, I should name a few of the Symmetry. There's a few others that is the one, the biggest trade they make their money on. And there are traders as well at some of the multi-strats that make many hundreds of millions a year or billions a year on that trade. So there's at those funds themselves, there is no impetus to actually the traders don't want you to do it algorithmically, right? That's what they do. So I'm going to say that it's only at smaller funds that they might consider it. The challenge with doing it algorithmically is you need to know there's some data that's a little bit harder to get. Is the repo, it's a repo for old bonds, for the cheapest to deliver. So that's makes it a little bit more challenging. But we can talk about it in more detail. But I'm going to say that it would be an interesting thing to be able to do. The challenge is being able to do it in a way that you feel safe doing that. Sunil had a couple more questions about feature selection or model selection. So, I mean, the thing about, oops, sorry, I went ahead. One of the things about, feature selection is that, I like the idea of regularization. I'd like to never have to choose a feature again. It doesn't work that way in practice. You generally have select your features even before you do your regularization. But regularization is one way to circumvent some of the feature selection methods, is because, especially if you use like some sort of sparseness constraint, like an L1 a lasso constraint, it effectively constrains the features and makes it much more robust. Anyway, I guess we should going along those lines here, we have in as one of the things we will discuss was regularization versus model selection, and using and how to use that as a sort of a slightly more automated fashion. I'm going to say most things can't be done in a fully automated fashion. We'll discuss that in some detail, why that might be the case, but especially because there's no single performance measurement that works for everything. We'll discuss things like the Sharpe ratio. We'll discuss things, and actually that's in one of the next slides. I'll get to that in a second. Okay. Brian, maybe you can cover this next one.
Sure. So, as Nick alluded to earlier, when presenting the results of your back test, or saying, hey, my strategy works, here's the historical performance, etc. One of the key things that people miss out on is they forget the kind of what they call the implementation shortfall, which is that when you actually trade in reality, particularly if you're trading any size, you will experience commissions, you will experience slippage, where you can't trade at the mid price, in other words. Okay, so you have to trade at the bid, or even worse, depending on where the market ends up if you're selling, and at the ask if you're buying, and so on. So there's all of these issues around how the individual markets are structured. Are they exchange based? Are they over the counter? Can you get direct market access? Can you use VWAP? How do you actually go about executing your trades? And all the different markets are quite different in their features, not this idea of market microstructure. And there's been a whole industry in academia, really, the last 20 years, publishing papers about the impacts of microstructure, and how a lot of the kind of so-called anomalies that people saw in the past and said, hey, you can do this, and there's this new factor we've come up with, and it actually leads to some amazing results. Well, people have actually looked at many of these and found that actually they're a result of some microstructure feature of that market that hasn't been properly accounted for in the testing. So there's a whole ecosystem, and there's a literature, and there's a lot that you can study and learn about in how to adjust your strategy, how to adjust your results for these costs. And it's a really interesting area, actually. Like, obviously the more you trade, the larger your trade, the larger the cost, but it tails off in a kind of a concave fashion. So there's these there are many models for the impact of trades, and there are academics who spend their entire careers studying that. Mm-hmm. And it's particularly important, I guess, is this very last point, for market makers, but they really make their money by kind of sitting in the middle, obviously. So how the market actually moves, and the impact the impact on prices is of great concern to them, and it's in a sense how they make their money, but it's obviously got to be in a controlled manner.
I guess then we'll also talk about risk models, how we deal with large covariance matrices, depending on the asset class you're trading. If you're trading equities, then of course you may have to deal with very large covariance matrices. How you should go about stabilizing it, because one of the things that's clear, I say, unlike other areas where machine learning works wonderfully well, we work in markets which are non-stationary, which mean and have low signal to noise ratio. So there's a lot of noise, and we want to extract as much signal as possible. And the non-stationarity means we never have enough data. Despite the fact we may have very, very large cross sections of data, but never enough time series of data. And so the risk models, there's a lot of theory that goes into how to fix your risk models, and there's a lot that can be this can actually lead to significant gains in performance. There are notable traders who've especially in places like StatArb, where they've done a significant amount of work in their risk models, and it's really improved the risk adjusted performance. We'll talk about mean variance optimization, the intuition, the benefits, what its shortcomings, why it doesn't work really in practice, but then how it's put together, either through tactical asset allocation or some other sort of form of stabilization. There's quite a number of other forms of stabilization. We'll look at the tricks of quadratic programs, because there's ways of using just a simple QP method to consider turnover constraints, transaction costs, various different limits. And it's one of the few places where you can, if you have lots of models for your alphas, that you can actually consider how you should be allocating across them. And then we'll look at basically how do you get from alpha to allocation, and that's one of the challenges, is that despite the fact we're all interested in forecasting, forecasts are the forecast is not really the end goal. The end goal is really it's really the allocation. It's allocation. It's the execution, and so we'll talk about various different ways that alpha goes straight into allocation via transform or some other method, sometimes slightly newer methods. We'll talk about restricted strategies. Some of the largest quant trading strategies in the world are risk parity strategies. They're large funds, huge, many billions of dollars just allocated by risk parity. Very, very simplistic strategy. You could say it's nothing to write home about, although people have made a lot of money just managing risk parity funds. Similarly, min risk or low beta, which is a type of anomaly. And then other ways of using the same methods in our allocation using hierarchical risk parity. Now, Harmanjit was asking about if we could please share a brief insight upon optimizing execution using market orders. So we'll be talking a little bit about that. There's a number of different models on how to go about doing that. We cover Brian. You cover some methods there. There's a number of other methods to go into. This area is basically it's an area of stochastic control theory. Brian, maybe.
Yeah, there's a trade-off really with market orders. You can guarantee that you get your order filled by just executing the full amount immediately. Okay, so that's guaranteed execution. But that will generally give you the worst price because you push the market against yourself. Or the trade-off is that you have a probability of fill or execution less than 1. And the trade-off is you get a better price by executing slower over time, somehow, using some model. Could be over the course of the day, could be over the course of an hour or a minute, depending. But that's essentially all that the program does. It essentially just it's essentially like I say, it's a trade-off between two things: the probability of fill and the quality of fill.
It's sort of like mean variance optimization.
Right.
You just you pick your point and then you do it.
Yeah.
Okay. There's actually quite a few types of order types that one can do, and we'll talk primarily about market orders. And there's some of course, some of these strategies are constrained to be only filled using market orders, especially if you're in a QIS desk. It has to be a market order. But of course, if you're slightly more sophisticated, then you're also potentially using market orders and limit orders or spread orders. There's quite a number of other types of order types that one can use. Again, this is an area of active research. I have a PhD student working on optimizing using market limit and spread orders simultaneously. We'll be looking at realistic testing and approximating execution costs. How should you go about doing a reasonable back test, and how you should do your sims, how you should measure performance, whether it's the Sharpe ratio or the Sortino or an Omega ratio. how you should look at drawdowns. People typically look at CalMAR ratios. There are many, many other measures. I say none of them is perfect. We'll look at, optimizing them, which is sometimes done, but it's sometimes done as sort of a first step, or even multi-objective optimization to understand if you optimize your Sharpe ratio, you may not be optimizing your CalMAR. And in reality, a lot of, despite optimization, a lot of times this is not done fully in a fully automated fashion. When it comes to, this is effectively choosing hyperparameters, choosing parameters that you're not going to vary over the course of the lifetime of your model, that where you're trying to set how quickly it learns, or how quickly it forgets, what the look back horizon is, those sorts of things. They're effectively hyperparameters, and there's many ways of doing that, but oftentimes they are effectively hand tuned, and then revisited if something goes terribly wrong. So this is an area that people work on a regular basis. And then we'll also cover risk management fundamentals, whether it's value at risk or effective expected shortfall, slight variation in value at risk. I know there was a lot of debate about the difference between the two of them and how one is sub-additive and one is not. And despite the fact that expected shortfall has some niceties to it that value at risk does not, most risk managers will tell you in practice value at risk is that it is really good, that it's good enough effectively, and it requires slightly less. Typically, it requires slightly less assumptions than effective shortfall does. We'll look at funding issues, and how you have to fund the trade matters quite a lot to how much you can get out of it. This is an important thing in some areas more than others, where your leverage really matters to the type of returns you can get. We'll look at stops and trailing stops and risk management issues specific to algorithm trading, because a lot of risk management has to take place sort of outside or after the algorithm rather than as part of it. But it has to take place outside the algorithm, something you do, something before the risk manager steps in, because you don't want to deal with risk managers if you can help it. Okay. So in terms of the prerequisites, what we think our students typically have had is typically Python experience. So intermediate or experienced programmer, preferably with working knowledge of Python, because some of our examples would be Python based. I'm not saying it's going to be a very Python heavy class, but there'll be an expectation that you'll be able to program in something like Python. Of course, if you wanted to, I don't know if Brian, you and I haven't discussed this, but if you want to submit the final report in C++, I think it's legit as well.
I think between Nick and I, we've got most major languages covered, so that's fine. Yeah.
And then statistics or econometrics or machine learning background, we'll assume some strong familiarity with a lot of statistical concepts. Not to say that there'll be some review. We'll talk about the statistical estimation, probability, a review of that, but sort of an understanding or familiarity with basic distributions and hypothesis testing, and OLS is a bare minimum. Although again, there's some effectively review module on it. R Markdown documentation is perfectly reasonable. It's I'd say very pretty to use R. Basic finance and familiarity with economics. We assume a basic knowledge of financial markets and a basic understanding of utility theory from economics. So sort of as a motivation for how to go about doing that. Now, students have come with varying different backgrounds. I'd say a large number have had industry experience, and then some have had quant or trading or even systematic trading experience, but not everyone, because there are some with less familiarity. Maybe they're more knowledgeable about the coding and less about the other quant areas. but there should be some. We're going to move a little bit more quickly in terms of some of these, in terms of, say, just assuming basic knowledge of some familiarity with economics. So, and it's not even serious economics. We're not talking about that you have to know micro and macro theory, but more about the impact of releases on the markets. That's much more important to us now. And then a plus is some familiarity with SDE and differential equations, although that's not such a big deal because this is not a pricing class. We're not going to be covering Black-Scholes in great detail, although there are some strategies involving options. I'd say they're not really heavy duty into new pricing methods for options. And then there's a written assessment at the end, which could be, as we said Python notebook doesn't have to be Python. It can be, Jupyter it's Julia, Python, and R is where it started, but it can be any of those languages. Describing a strategy in detail, the behavior, the rationale, implementation, and performance. And especially if you can assess your own strategy, where the limitations and room for improvements are. Now that you may not be pitching that to your investors, but you have to know that yourself. And the marks are for sensibility of coverage and exposition, for following the methodology, and it's not just for performance. When you come up with strategy, it doesn't have to be the best performing strategy, but a strategy that's sort of well justified is an important thing. Okay, so I guess we'd be wrapping it up what we've covered now. Brian, maybe I can let you go from there.
Sure. So as we said at the beginning, and I guess you're all here, so you have some awareness of this, that algorithmic trading is both a huge but also growing part of financial markets. I mean, you read stats all the time, and you can't keep up with them about how much of, say, the US equity market, how much of execution is done by algos, how much of the bond market, etc., and on it goes, and all the other markets that are less impacted to date are being increasingly automated, increasingly subject to systematic or algorithmic trading. So it's only increasing, and as more and more data becomes available, there's going to be more and more jobs basically available in the area, but also research going on in the area, and just in general, the ecosystem is growing at a ferocious rate right now, and will do for the next few years. And it's just really a few things have come together. Computing power, GPUs, machine learning, more data, and the more kind of direct access opening up to the exchanges and to the various trading venues. So it's becoming easier, cheaper, and more common, I guess. There's more capital being deployed into algorithmic trading. Right now it's much easier to get investment into something that's systematic than it is in something that's discretionary. I think discretionary is not dead by any means, but it has, it's had a bad run, and I think people are, if only for the reason of cost, people are very focused on algorithmic approaches. And the universities are, very few are offering something that I would say is very focused on this area. From what I gather from the kind of universities I'm involved with, there's not really any major plans to have a master's in this area as such. There's the odd course within master's programs here or there and around the world, but it's very much, I think, for individuals to get the information they need and the skills they need really outside of university. So you have the basic skills, and then you go, and through a course like this, you find those other building blocks you need to really start going, to start developing algo trading strategies, either for yourself or, for a small group, or as part of a job in a bigger organization.
So I'm going to say that a lot of times, so a lot of quant programs in universities are purely price and quant. So either price and quant or maybe risk management. And I say that it's been that way for many years, for around 20 years. But then increasingly there are some quant courses that have now started to introduce more machine learning. Some machine learning in finance. Now, a lot of the machine learning courses are effectively it's like you're putting finance and you're putting machine learning side by side. They don't tell you how to deploy machine learning into financial markets. So there's a lot of machine learning courses out there that may or may not be successful in terms of what you can do with it. And so our goal really is to talk specifically, as has been the case of the course at UCL, is specifically about what are algorithms for trading markets, and how can one go about deploying algorithms specifically for trading markets. As I say, that's relatively limited in terms of its coverage. There are a few courses out there. I think it will only grow in time. I'm hoping so, because but I think that it's as I said, right now there's only a handful of such courses. And let's see so basically the algorithm trading practitioner's guide is aimed to give you the practical skills for getting started in this area. I think that's the last slide. We did have there were a couple other questions here, and I know that Arshia asked about having a master's in mathematics. There are more opportunities for engineering and business finance students. How do you think this course will help in terms of credibility when looking for jobs in India? Well, I'm afraid that's something that's slightly beyond our expertise. I do know many students, for instance, who from India who take the course at UCL that I have. There are many students from China who take the course from UCL. There are many students from Europe as well, and from Britain also, because it is the United Kingdom. But this is an area, I think it's an area that my sense is a lot of people have thought that this is an area that they felt lacking in, and that given a very STEM background, this is algorithmic trading. Our course is something that accelerates your move into this direction.
Nick, can I add to that?
Sure.
Because I've been responsible for recruitment in the sector since 2008, including in India. And what I would suggest is that it's great that this course has been extended to 3 months, because what it means is that you can do more work in between the lectures in order to reinforce the learning. And the acquisition of knowledge and applying what you're learning, which is what this program is about, will enable you to speak the same language as the people who are interviewing you, wherever you are in the world, whether it's India or anywhere else. And when it comes to the interview, it'll be probably the desk head who's interviewing you, and somebody from HR, and there'll be a panel of 2 or 3 people. And once you've finished this algo trading certificate, you'll have the knowledge and skills, not only the knowledge and skills, especially the more work you put into it, but you'll also be able to speak the same language as what they're talking about. I think that's extremely important. The other thing, just in terms of approach to interviews in general, this is something that we help with. And we help with doing as much reading and research as possible, not only with you'll be given the job spec, but you need to do your research on how that job role fits into the team as a whole, how the team, what the team's function is within the organization as a whole. Find out about the organization, find out about the competitors, do as much as you possibly can to prepare for the interview. Uh, and then you'll go into the interview with a kind of spontaneous ability to respond to their questions, and with the knowledge that you gain from this program as well, coupled with that, you should be in a really good position. So I think that's really how to approach this, is just to kind of work as hard as you can during the program, and then when it comes to interviews, this is something that we can help with. So we do have a lot of contacts out there. So once you finish the program, you get in touch with myself, and then I'll do what I can to help you out, not only in terms of the contacts that we have, but also in terms of interview techniques and so on.
So Sunil asks about how much algo trading is impacted by Gen AI, LLMs, and auto AI. And I'm going to say that so there's there is a fair amount of use of sentiment analysis. I'd say less so LLMs. I mean, LLMs. I don't want to be too derogatory, but in some sense they're like if there's anything important that goes on in an LLM, it goes on behind the scenes, and the LLM itself is like a fancy user experience, a UX or UI, because the actual calculations are what we care about, and if it's a machine learning based calculation, then it's likely there's not going to be a large language model at all, or there may be no so NLP, natural language processing, matters for things like reading the news, and that's increasingly important. And for event trading and things like that, that's increasingly important. I'd say Gen AI slightly less so. Okay, and Nancy, I know you asked about Concoda, and I know this it's a newsletter and a Twitter account. Concoda seems very good. I've only just recently experienced. I haven't read in great detail, but they seem to be whoever it is seems to know what they're talking about. And the chat rooms I have on Twitter, they're very aware of this person and their read on the market. So that's quite an important thing. Okay. So someone asks, hello to all, working nowadays as a front office developer on FIC trading desk in Europe, and with CS background with certificate enabled me to go closer towards algo trading desks in EMEA or APAC. Well, I certainly hope so, because I think we give what we think are the necessary information, the necessary background. A lot of people, there are people get involved straight out of school just because, and a lot of people aren't necessarily trained up. They sort of land jobs by accident in algo trading desks. But we'll tell you specifically about the things that we think you need to know in order to work in one of these areas. I mean, of course, it can be tailored specifically to each area. So so it depends on, if you're in a market making team in a sell side firm, maybe it would be using KDB, and that's something we won't go into detail because that's a potentially class in and of itself. But we will go into detail about the algorithms that one needs to deploy, whatever the language. But I think so far I may have covered all of the questions
I think
here.
so, yeah. I've just been looking back. I think we've gotten them all. I guess we're over time as well.
Yeah. But one way or another, we hope that the class can be as interactive as possible. We like feedback. We have, and it's structured by that we have these 2 hours plus of recorded lectures per week. That's and then we have our 1 hour of live lecture And we have a forum. We try to answer questions throughout the week because I think it's an important thing to have this sort of interactive nature. And then the 1 hour of coursework. So 1 hour course, 1 hour of live class that Brian and I host, that where we hope to get feedback and hope to involve you in discussions.
Nick, Brian, thanks very much for explaining this program. I hope, I hope you've all found it really useful and informative. And if you've got any questions, feel free to contact me at any time over the phone or by email. And enjoy the rest of your days wherever you may be. Thanks a lot for coming along.
Thank you very much.
Thank you.
Take care. Okay, bye-bye.